Hey everyone, welcome back to Finance Deep Dive. In this video, we're breaking down what's really happening to the US economy, from stocks and inflation to interest rates, jobs, and what it all means for your money. The signals right now are confusing, the headlines are misleading, and the reality might surprise you. So let's get started.
So what is it? Is the US economy stronger or weak? I mean, this is the biggest question out there right now. And honestly, the signals are pointing in completely opposite directions. You see all this data, the market headlines, and they look great. But at the same time, you talk to people, and so many are feeling some serious financial pressure. How is that possible? How can both be true?
Okay, let's just look at this contradiction up close. The stock market, right? A huge indicator. It's up over 15% from this time last year. That's a bull market, plain and simple. And yet, consumer sentiment surveys, they show widespread concern. People feel like the economy is weak. So to really get to the bottom of this disconnect, we've got to start with the one thing that affects everybody's wallet: inflation.
All right, first up, inflation. We keep hearing that the rate is coming down, which is good news, right? But for most of us, a trip to the grocery store or the gas pump, well, it still feels pretty painful. So what is the real story here? So here's that key headline number you've probably seen. The latest annual inflation rate is sitting at 2.7%. Now, don't get me wrong, that is a massive improvement from the 9% peaks we were seeing not too long ago. But, and this is a big but, it is definitely not the end of the story.
Just look at this gap. Yeah, 2.7% is a big improvement, but it is still stuck well above the Federal Reserve's target. They want it at 2%. This is what you hear experts call sticky inflation. It's just proving incredibly difficult to get all the way back down to normal.
And this quote really nails the core problem. See, even as the rate of price increases cools off, those higher price levels are pretty much here to stay, and that just continues to squeeze household budgets. I mean, look at specific costs like hospital services. They're still up a whopping 6.6% from last year.
Okay, so if prices are still stubbornly high, what's happening with our paychecks and jobs? Let's switch gears to the job market, because this is another area where the headlines just don't quite match the feeling out there on the ground.
The official unemployment rate? Just 4.4%. I mean, on the surface, that sounds incredible, right? That's nearly a historically low number. So why does the job market feel so shaky for so many people?
Well, it's because when you look underneath that headline number, the story completely changes. The economy only added about 50,000 new jobs in December. That is a dramatic slowdown. And maybe even worse, real average hourly earnings, that's your pay after you factor in inflation, were completely flat. People just aren't getting ahead.
And this really suggests we're entering a whole new phase. You know that post-pandemic hiring frenzy? It's officially over. It really seems like we've settled into a much slower, lower growth reality when it comes to jobs.
Okay, let's do a quick recap. We've got sticky inflation that's squeezing our budgets, and we've got a job market that's hitting the brakes. So how on earth can the stock market be booming? What is going on? I mean, the S&P 500 index has just been soaring, recently hovering over 6,900 points. It's nuts. Despite all the economic uncertainty we've just laid out, some analysts actually believe this structural bull market isn't even over yet. So what in the world is powering it? Well, here's the answer. This rally is being powered by a really, really narrow set of things. It's not the whole economy firing on all cylinders. Nope. It's a massive wave of investment that's just pouring into artificial intelligence, all the data centers you need to support it, and the super powerful semiconductor chips that make it all possible. So this isn't a rally based on, broad consumer strength. It's a very, very specific tech boom.
So this strange mix of a slowing real economy and this booming tech market, it puts the Federal Reserve in a really tough spot. They're trying to walk this tightrope of fighting inflation without completely crashing what's left of the job market. So what's their next move with interest rates?
Okay, so to try and give the slowing economy a little boost, the Fed actually cut interest rates 3 separate times late last year. And that brought the benchmark federal funds rate down to where it is now at 3.75%. But, and this is important, don't expect more cuts anytime soon. With the labor market just kind of stabilizing and inflation being as sticky as it is, major analysts now expect the Fed to just hold rates steady for the foreseeable future. We're talking potentially right through 2026. The era of easy rate cuts? Yeah, that's over.
All right, this brings us to the biggest question of all. What is the single hidden force driving all of these contradictions? A hot stock market, a cooling job market, and inflation that just won't go away. Well, the answer isn't a normal economic cycle. It's a massive and very recent shift in government policy.
It really all comes down to a law called the One Big Beautiful Bill Act. It was signed into law recently, and this huge piece of legislation is just fundamentally reshaping the economy. How? By injecting a massive amount of stimulus directly into people's pockets.
So let's take a quick look at what it does. It made those 2017 individual tax cuts permanent, it beefed up the standard deduction, and it introduced a whole bunch of new tax breaks for things like tip income, overtime pay, and even the interest you pay on some car loans.
Okay, so here's the key takeaway from all that. This law is what we call fiscal policy, government tax and spending, but on a massive scale. It's definitely propping up consumer spending and overall economic growth, but it's also the main reason why the Federal Reserve is finding it so incredibly hard to get inflation all the way back down to that 2% target. You've got the government pushing the gas pedal while the Fed is trying to hit the brakes. They're working against each other.
All right, let's bring this all home. What does this policy-fueled, totally contradictory economy actually mean for your money?
Well, it creates what economists are calling a K-shaped economy. Just picture the letter K, right? One arm goes up and the other goes down. Higher income households who benefit most from a rising stock market and are responsible for most of the spending out there, they're doing great. That's the top arm of the K. But the broader sentiment surveys, where everyone's voice is equal, show that most other people are feeling squeezed and really concerned. That's the bottom arm.
So I think the biggest takeaway here is this. We are not in some traditional boom or bust cycle. Not at all. We are in a unique, high-cost economy that is being directly fueled by government policy. And that leaves us with the most important question for the future. Is any of this sustainable? Can this kind of policy-driven growth actually last? Or are we just setting ourselves up for some pretty big unintended consequences down the road?
Thanks for watching. If you like the content, don't forget to subscribe to Finance Deep Dive. It motivates us to keep posting.